Hello, everybody, and welcome to the Tax Talk at Evershed Sutherland. I'm happy to be here, happy to have my esteemed colleagues here with me, who I want to introduce in a minute, or ask them to introduce themselves in a minute. Today, we have a very interesting topic. We will be talking about the new draft directive by the European Union called DEBRA, which is an acronym for Debt Equity Bias Reduction Allowance. Very interesting, very up-to-date topic. So I will first ask my colleagues to introduce themselves. I will ask you, Deepesh, please give a brief introduction.
Sure. Thank you, Lars. My name is Deepesh Upadhyay. I'm a tax partner here in the London office of Evershed Sutherland. I specialize in finance tax matters, acting for a range of debt funds, global banks, and a range of financial institutions. I'm looking forward to speaking to you all today. Thank you.
Thank you, Deepesh. I am Gianluca Nemec, Principal Associate of Evershed Italy. I'm a tax lawyer based in the Rome office, and I've been dealing with international tax law for 16 years. And today I'll provide you with a brief overview of the Italian legal framework regarding DEBRA.
Hi, so my name is Feria Adili. I'm a principal associate with the Paris office of Evershed, working with the tax department, mainly corporate tax and transaction. And I will present you some of the first thoughts regarding the impact of the DEBRA directive from French perspective, of course.
Thank you very much. And I'm Lars Haferkamp. I'm a tax partner in the Düsseldorf office in Germany of Evershed Sutherland. I focus my practice particularly on international tax matters and transfer pricing. And especially from a German perspective, this is a very interesting directive, because we've been talking about debt equity requalifications for a long time now. So this is really something that should be important to our clients, not just in Germany and Europe, but I guess globally. And I want to give you a brief introduction of what is the new directive talking about. Next slide, please. So debt equity. So what has been determined by the European Union is that obviously in all European countries, and you are probably well aware of that, debt financing, the debt is deductible for tax purposes, whereas equity contributions by the parent company into their subsidiaries is not, which has led to a situation, especially here in the European Union, that most companies are over indebted, meaning they are financed particularly by debt capital and not by equity capital. There's something that will or may lead to certain difficulties in times of crisis, like we've seen for the past, I don't know how many years, we cannot count. So the European Union wants to do something about it. So they have drafted this new directive whereby they want to mitigate this unfortunate situation. And this is a two-step approach, if you like. So one is a form of thin capitalization rule, although it's not an actual thin capitalization rule. It's a limitation of interest deduction on the one hand. So that is something that we probably know in most jurisdictions in Europe and worldwide. And the other one is actually very new. It is a notional equity interest deduction. So it's something that is fairly new in many jurisdictions. I know we have that in some jurisdictions like Switzerland, but not so much in most other European jurisdictions. Next slide, please. So there have been different approaches. So there were different options how to mitigate this. There was a lot of discussion on EU level between the member countries. And the preferred option at this time, and we don't know what will be the end of this, is the just mentioned two-step approach, where we look at what is new equity, corporate equity in a certain subsidiary in 1 year, and provide a specific notional interest deduction for that, and then the limitation on interest deduction for debt capital. Next slide, please. Yeah, on this very slide, we on option 5, we go a little bit more into detail, and for you will be able to download this the slide deck for your reference from our website if you're interested. What we have here, so one part is we have an allowance on new equity. So this would be, as it says on the left-hand side, an allowance base plus a notional interest rate granted for a 10-year period. So that has already been determined. So what's the allowance base? That is basically looking at equity at the end of a financial year and compared with the equity capital of that company at the beginning of the year, and the difference, the balance, would then be our allowance base. So this is very straightforward and understandable. And on that allowance base, we would then be able to, or with that allowance base, we would be able to multiply a certain notional interest rate, which is based on a risk-free rate plus a risk premium. The risk premium will actually be in the law, it's 1% or 1.5% for small and medium-sized enterprises, whereas the risk-free rate is determined by the jurisdiction of that particular company. So in Germany, for example, I looked it up this morning, in 2021, it was 0.6%, so not really much. So we would be talking, for most of you, of an interest deduction of 1.6%, which is obviously not much, but that is what is being offered here, let's say, by the draft. On the other hand, we have the limitation of interest deduction, which I guess is a part of this option to actually make it more interesting for companies to comply with this. So what was that? That is 85% of what is called the exceeding borrowing costs are deductible for tax purposes, but not the difference of 15%. What is an exceeding borrowing cost? Well, that is basically deducting your interest received from your interest paid. The difference is then again the base, which is deductible, but only 85%. And the directive also appreciates that there are already thin cap rules after the different ATAT implementations, where only 30% of the company's EBITDA is deductible in most jurisdictions already. So this will be considered, and both regulations will go hand in hand. On this slide, you will find a little example how this works. It will not substitute the existing thin cap rules, but it will basically be on top of that. Next slide, please. And then again, there are obviously anti-abuse measures already in place. So the EU Commission already recognizes that there is leeway for structuring, and they try to tackle this upfront. So one is equity allowance is limited to 30% again of the EBITDA. So this is in line with thin cap rules, which we have in the European Union and most member states, I suppose. Then there are certain equity increases which will not be considered. So that is very interesting. And at this stage, I would think this is only a proposal. Next slide, please. So what will happen here? An example which illustrates the equity increase limitation quite well is the following. So you have the parent company which contributes equity into a subsidiary in country A, member country A, which will then in return use that money to hand out a loan to another subsidiary in country B, which will then again use the same money to contribute equity again in another subsidiary in country C. So if you have this sort of downstream capital contribution with a loan interjection in between, the draft clearly states that this would be abused to claim the notional equity allowance twice. So you are only allowed to claim it once. I mean, that sort of makes sense from an anti-abuse perspective, and has been envisaged by the Commission here quite well. Next slide, please. Yeah, and on the other hand, it has also been recognized that there may be issues with the valuation of the different equity contributions, the assets, and so forth. There will be clear rules. I guess the limit is the market value of certain assets which are being contributed as equity, which makes sense. But on the other hand, these rules on the overvaluation of equity are still quite vague, and we will have to wait and see what will come out of it. I think that is safe to say. This directive is supposed to be implemented by 2024. It is quite advanced, at least in my perspective, but it's not yet there. So it's not yet final. I guess there are still some discussions to be made and some detailed regulations to be formed for this to actually take effect. With that, I would like to start a conversation here with my colleagues from the different jurisdictions and discuss how this might affect their own country, the investments by companies in or from their own country, and whether they may even have sort of the same rules already in place. With that, I would like to ask you, Feriel, so how does that DEBRA regulation, how do you think this will actually add to the current tax arsenal in France?
Yeah, so first of all, it's worth pointing out that both mechanisms provided by DEBRA are new to the French system. So unlike Italy, which already has, I believe, interest incentive, in tax incentive, about new equity. France had considered it in the past, but never implemented it so far. So now, if we have a closer look on this new limitation rule, well, clearly what we can say is that this, if it applies, this will result in a more restrictive outcome than the one which is applicable under the current system, which is the reflection, as you said, of ATAD 1 directive. In the sense that interests which will be caught by DEBRA limitation will be definitely lost. Whereas under the current regime, when interests are not deductible for one fiscal year, for one year, it still could be carried forward with no time limit and eventually become tax deductible at some point. The only condition restriction is that the company needs to be not undercapitalized, meaning that the debt to equity ratio needs to be sufficient enough, and then those interests could be carried forward with no time limits. Where here, those interests caught by DEBRA will be definitely lost. So that's the first observation. The second point I believe that needs to be considered is the impact on the profit sharing. So profit sharing, as you know, is no more than an incentive for employees. And the standard formula of a profit sharing is based on, well, takes into account, in one hand, the taxable profit and also the equity. So if the taxable profit is higher, the better it is for the profit sharing. So DEBRA, in that sense, because it restricts more the possibility of tax deduction, should be a good news for the profit sharing and for the employees. But on the other hand, the equity, conversely, if the equity is higher, then it will necessarily reduce the profit sharing. So if DEBRA achieve its goal, which is to go for push companies to choose equity rather than debt, that could have a very negative impact on the profit sharing. So that's something which will need to be considered by the companies when they choose debt over equity. And so the outcome of it in general is that the DEBRA directive, it's difficult to see how positive will be for the companies, the effect of DEBRA in France to date. There's a lot of suspicion about it right now.
So you're saying when you say profits sharing, so you think that would have an effect on also on the employees of the company? What is your take on that?
Absolutely, because the profit sharing is no more than an incentive for it's an additional income at the end of the day for the employees. Yeah. So you might thought that DEBRA could have, but it can go either way, to put it simply. It could go either way. If DEBRA really achieved its goal to and change the course of action for the companies to choose equity over debt, that could have a very detrimental for the employees, actually.
Okay, interesting. I personally haven't thought about this, but there's a very interesting take. So this directive could actually affect not just the companies, but also the employees of the company. Very interesting, Feria. I really like that take on it. So I think that would be a very dramatic impact, and probably something that wasn't thought about when they proposed this, obviously. Maybe interesting to hear from Gianluca, because as you mentioned, I understand also in Italy, you already have similar rules in place for quite some time, don't you?
Thank you, Lars. Yes, I may confirm that here in Italy, we already have a specific provision similar to option 5 of DEBRA project, because the national deduction interest deduction rule has been introduced in Italy in 2011, and under this regime, the Italian resident companies may deduct a national interest from their corporate income taxable base, and the deduction is substantially, the rule is quite complicated, but substantially is equal to the net equity increase from the end of the fiscal year 2010, multiplied by a rate which is determined annually, and consequently the contribution in cash by the shareholders and profit generated in previous year not distributed are the so-called positive equity adjustment, while any assignment in favor of the shareholders are considered negative equity adjustment. Mm-hmm. In the recent years, it was equal to 1.3%, but a new law decrease has strengthened this, let me say, this regime on a transitional basis, and the deduction to support the Italian companies during the pandemic. And for 2021, the rate is 15%, and with a maximum of euro 5 million. So any equity increase beyond this threshold of euro 5 million euro may benefit from the national interest deduction rule with the ordinary 1.3% national yield. And also we have, in addition, I would mention that also in Italy, we already have this anti-avoidance rule that this is currently under discussion at the European level. And the net, in order to avoid the duplication of the tax relief, so the so-called circular operation, and also in this case, the net in Italy, the net equity to be taken in consideration must be decreased by the cash contribution made in favor of Italian and resident company and non-resident company, less the any acquisition of participating interest in related or associated companies, as well as business acquisition from group companies. So the application, I can say that the rule is quite clear here in Italy. As usual, the application of the rule is not so easy.
Yeah, I was about to say it sounds very complicated from someone who hasn't dealt with this before.
Yeah,
But
yes. Let me add the most complicated things is that you when, for example, you assist a new client, you have to go back to 2010. Sorry, yes, to 2010, because you have to check all the increases and decreases of the net equity starting from 13 and 20
okay.
years ago. So it's very difficult to have to track all these increasing and decreasing for example, for a new tax consultant that does not know the history of the
Okay.
company. It's very difficult.
That's interesting. So that is because you look at the interest on a per year basis, I suppose. So similar to the directive, the draft directive, I must say, as it is as of today. I mean, it seems that option 5 is the preferred option because it has already been tested, I suppose, in Italy, and therefore, it's just my assumption this will probably be the one that we will face in Europe, in wider Europe, let's say, in the future. So I think it's very interesting to have your experience here. So I understand the rules are basically the same, and the difficulty is this yearly tax allowance base, this check of the yearly tax allowance base. Oh, that's interesting, and something I guess our clients or the audience here has to consider also from a tax compliance perspective. I think that is the major hiccup here, right? You have to take care of this every year, and that is something where the compliance systems have to be prepared. If that is actually being introduced in 2024, you should be prepared for this event. Okay.
Yes. Because the new rule has been introduced in 2010. So you have to understand what happened in each year starting from 2010, and you have to do these operation every year. So okay, it's not so easy to calculate this allowance, but okay, it is an important instrument. I think that it will be strengthened also to the DEBRA directive, also here in Italy.
Okay, interesting. Another question, I think, which is very interesting for our audience and for everyone who hasn't worked with this. How did that affect in Italy, the choice, if you like, between loan and equity? I think that is something we all want to know.
Yes, this aspect, let me say that it is always evaluated by the multinational group when it comes to make a decision between contribution and debts. And it is also always discussed with the tax consultants in all the structure memorandum we prepare for our clients. We usually insert a specific paragraph on this, and it is always discussed. To tell you the truth, Lars, on the basis of my experience, I can say that I've never seen that this rule guides or changes the choice of a group. Of course, if the rate, the deduction goes up, things could change. At the moment, it is an important aspect, but it is not a driver in an operation of a new investment in Italy or.
Totally.
Okay.
One question from my side, Gianluca, just a real quick one, because you mentioned the interest rate. I understand from the draft you would have a risk-free premium or interest, part of the interest, which I understand they want to base on the specific country bonds, for example, so risk-free premiums, and then you would add a fixed, that's what it is, a fixed risk premium of 1%, which doesn't sound much to me, but it may be. So I haven't looked at the figures yet. But as I mentioned earlier with the presentation, at this point, I think it's 0.6%, the risk-free part of that interest. Is that the same rule in Italy already?
In Italy, it is fixed up to now. It is
it's
fixed.
All fixed. Okay.
Yes. Let me say that the first years it was around 4%.
Yeah.
Then maybe the rates went down, and also these, of course, allowance follows these rates. I don't know now that the interest rates are increasing. What could be the response by the Italian government for the 2021? It is 15%, but it is due to the pandemic to support the company.
Okay.
And so it is a temporary provision.
Interesting. So it's an incentive tool. Feria,
Yes.
I think you want to mention something.
Yeah, absolutely. I mean, I can only agree with the comment made by Gianluca, because the real question, because we can see clearly the downside effect of DEBRA in terms of tax limitation. This will create, no doubt, a more restrictive environment, and this will add for sure another layer of complexity to the set of rules which are already in place. In France, we have a very large scale of rules which address, interest deductions, and it's not always easy to even apprehend, understand those rules for the companies. But so, with respect to the allowance, the real question will be: is the tax incentive attractive enough to counterbalance that downside effect, and or another way is would this tax incentive will be significant enough to make a difference and fill the gap, for the company and change the course of decision when you have to choose debt versus equity when you make your investment. So clearly today, this answer is very uncertain because of two main reasons. The interest rate, just like you mentioned, is still very low. And even though, despite of the inflation, it still remains not too, high enough to make a big difference. And also, I think there is one big point about this tax incentive is that it's not. It's reversible, like it's not final. There is this clawback mechanism which will erase this tax incentive whenever there is a decrease of the equity. And this, I think, might end up with a very negative result, if not no result. We will just end up with another restrictive proposal of their directive with no really any incentive at all at the end of the day. So
a wolf in sheepskin, we would say. So it sounds very promising, but then if you look at the details, it doesn't. That is also my impression. That when I saw the risk premium of 1%, I thought that was almost ludicrous compared to what you would probably have on equity side. But I really want Deepesh, who is our finance tax expert here, to also contribute, once from a UK perspective, but also from a market perspective, maybe.
Thank you, Lars, and thank you, Gianluca and Ferelli. It's very interesting because when these proposals were first announced, I guess it sounded quite dramatic. So from a UK perspective, obviously the UK has left the EU, and so these rules themselves don't directly impact UK companies in the way it will European businesses and companies. However, I should say that if a UK company has a permanent establishment in the EU, there could be ramifications for that business to consider there. It's interesting because the EU here is obviously trying to level up the position between debt and equity by offering this sort of stick and carrot or carrot and stick approach, where, okay, if you, as part of your funding considerations, if you go for equity, then here you go, here's a carrot, here's some tax incentive for you, whereas they're giving you the stick to the extent you opt for debt. And as Ferelli has already mentioned, we've got a fair amount of rules dealing with interest deductibility already. So adding this further layer or further set of restrictions isn't particularly, I think, helpful. from a market perspective, I guess you'd start by saying, well, of course, if you're a debt investor or a debt fund or indeed a global bank wishing to lend across Europe or provide credit solutions across Europe, it doesn't sound helpful that as a matter of policy, the EU is saying, well, we're going to make it more favorable to you as a business in the EU for you to pick equity over debt. I mean, you're potentially taking away business from these investors or debt providers wishing to offer these solutions. That's not doesn't sound helpful, right, for those investors. I mean, on the other hand, our friends, our equity investor friends, are obviously thinking, well, this could be quite good for us, right? But it's interesting because, as Gianluca said, this is something which has already been tried in Italy. So although initially when these proposals were announced, many market participants might think, gosh, this could be quite terrible for our business model of wishing to lend across Europe. What Gianluca has pointed to is that, in fact, it's perhaps not something in practice which could fundamentally shift the dial on picking equity over debt, especially if the rates that are being offered aren't particularly great, or if, as a matter of course, in terms of applying the rules, they're not particularly helpful, or indeed more practical considerations, like Ferelli has mentioned, in terms of what does this mean? Equity, by its very nature, is different to debt. You're offering somebody the right to share in profits.
Yeah.
So we're talking about behavioral shift. What does that mean for those businesses and the management? You're giving, rather than giving away a fixed coupon or an amount of interest, you're giving away profit. So there's more than just a tax incentive there to think about. It's you're giving away the right to future profit. Might that change the behavior of the business? Who knows? Are there, Ferelli mentioned employees, management, will they be like, well, hold on a minute. Do I want to do this? Is this a good thing? Will this potentially negatively impact the business? Am I disincentivized in a way if I'm giving away more profit? I don't know. But I think what I'm getting at here is, on paper, initially it sounded quite dramatic to many market participants, whether you're a debt fund or a lender, whether it be a bank or otherwise. In practice, I feel it may not be so bad if actually the incentive when considering the round isn't really as powerful an attraction for businesses to go down that route. I think interestingly, I just stepping back for a moment and comparing debt and equity, the two are, as I say, quite different. So it seems almost unnatural to offer the equivalent of a tax deduction for investing in equity, when by its very nature is quite different to debt. Obviously, we can understand why the EU is thinking about this and why it might be considered appropriate. But given that businesses already have these options at play as to what's good for their business, part of me thinks that, is this a step too far? As you've mentioned, it's only going to be in 2024 when these rules are implemented. I guess it'll be from that point we'll have to see, what does this mean in practice? What might be unhelpful is if and to the extent these rules do have their desired effect of pushing companies to pick equity, which, you know, there will be, of course, some positives to that. Could that lead to a sort of dry up of some liquidity? Might there be debt funds or other credit institutions or financial institutions saying, well, let's sort of scale back the amount of credit we therefore offer in Europe? Could that have bigger ramifications? I mean, obviously at this stage, hard to say, and obviously we don't want to sort of over dramatize effect, but these are sort of the sort of considerations that we might be having or thinking about, really.
Yeah. I think, yeah, as you mentioned, we're still early on, but it makes sense to think about this, think what the impact would be for your own company, your fund, whatever, your investments. Think about it now. Maybe think about if you have a situation where you're already uncertain, would we have, and I mentioned that at the very beginning, a debt equity requalification. So we have debt capital invested in a subsidiary, which might at some point be considered an equity investment by the tax authorities. It may make sense to think how to solve the problem interim wise, and then look at this again in 2024. Maybe the rules will be in favor of you then. So this is more or less a structuring idea which one might have, but also set up the compliance system. I think that is something that we've learned today. Set it up early so that you're prepared for this, and see what are the risks for your company and your investments. I want to thank you. I think we're running out of time here. I want to thank you all for this. It was very interesting for me. I hope also for our audience to get your thoughts on this. And I'm pretty sure we will be back on the same topic as this evolves a little bit more in the future. And with that, I want to thank everyone for listening to the Tax Talk video on DEBRA. And for any further information, please feel free to reach out to any of my colleagues or myself or your regular contact at Evershed Sutherland. We are all happy to discuss these things with you and are always at your availability. Thank you and have a good day.